Joining me now is Bank of America's Savita Subramanian. Savita, you've been looking at how a softening labor market impacts corporate margins, and I'm assuming they impact margins in different ways. How do you kind of connect what you saw from today's report with how investors should be positioning for different sectors moving forward?
Yeah, I mean, I think today's report does not necessarily mean that we are in a downward spiral in terms of economic growth. In fact, I think things still look pretty healthy. We've had a deceleration in labor inflation, which is actually positive for corporate margins. I mean, think about it. The U.S. is a service economy, and our number one cost is labor. So a little bit of a softening in labor prices is actually positive for margins. Meanwhile, real wage growth is still positive, and that has been linked with continued healthy spending. So I don't know if I would necessarily write everything off at this point. I do think that the Fed, kind of more likely to cut interest rates more aggressively in the next few months is something to think about, because what this does is it puts some pressure on cash yields. And I think that that's an area where folks have just sort of parked a lot of capital in this era where you can actually make money on your cash balance. And if those yields are getting trimmed, I would expect to see some of that capital flow into other sources of income, not necessarily bonds, but I think that we could see equity income catch a bid here. So I would actually be looking at some of the more beaten down rate sensitive sectors and think about them as, potential beneficiaries of inflows from retirees who aren't making as much on their short duration bonds and cash balances.
Going back to this dynamic of labor market weakening and potential benefits for corporate margins, at what point does that threshold kind of surpass the point where the labor market weakening means people aren't buying things, which means corporate margins get squeezed? I mean, is there kind of a period in time where it might be beneficial, but then ultimately pivots and becomes more of a headwind?
Yeah, so I would watch for mass layoffs. So one thing we've been kind of just slavishly watching in our earnings transcript feeds is, are we seeing companies really aggressively lay off workforce? And what we've really seen is kind of a pause. So no hiring, no firing, not necessarily, kind of that broad spread weakness where consumers are, really starting to suffer and losing their sources of income. I think that's what is most important in terms of the consumption story, because truthfully, U.S. consumers tend to spend, regardless of what the rate backdrop looks like, regardless of what they say in these surveys, they tend to spend until they lose their source of income, and that's the number one driver. So, if we start to see broad spread trends in terms of job cuts, I think that would be the negative for margins, for pricing, for demand. But at this point, with real wage growth still positive, with, unemployment at still kind of healthy levels, sustainable levels, I don't necessarily see this as doom and gloom for margins. In fact, I think if anything, it just shows us that, we're seeing a little bit of an alleviation in labor pressure. There are also structural reasons that the labor market is tight. We've got demographics, we've got immigration reform. So I think that those offset some of the potential softening in the labor market as well.
Yeah, absolutely. In terms of the overall market, does the timing indicator suggest to you that it's good to stay long here, despite what we've seen in terms of valuations today aside?
It's interesting because I think valuations, it doesn't feel great to buy the S&P 500 at these types of multiples. But I do think that a higher multiple for the S&P is warranted by the fact that, companies are actually pretty healthy right now. They've cut down a lot of their leverage risk from the global financial crisis. They're managing margins quite ably, despite the fact that we've seen massive inflation volatility and rates volatility. You've seen corporations exert a lot of these efficiency gains. So I don't necessarily think this is the environment where, typically the end of bull markets are where everybody is telling you to back up the truck on stocks, and stocks are the best game in town, they're riskless. Nobody's saying that today. I think we're still in that worried environment where the more typical questions I get are, I've been underweight U.S. equities, but it doesn't feel great to buy here. Should I deploy capital? Which means there's capital on the sidelines.